Founders Forum, Episode 4.
Open your mind to a new episode of the Founders Forum, the podcast championing a free economy, sound assets, and blockchain solutions. Each week, your hosts, entrepreneur Cole Snell and economist Bob Murphy, interview pioneers and free thinkers to help you develop into the architect of your future.
Welcome, everyone, to another episode of Founders Forum. Today, Cole and I will be talking with John Gagnon, who's one of the principals behind the website BOLI.com. That's BOLICOLI.com, which, of course, is short for bank-owned life insurance and corporate-owned life insurance. Let me just read quickly from John's official bio here, and then I'll explain a little bit about what we're talking about. So John has almost 30 years of experience in the executive benefits area in bank and corporate-owned life insurance. From 97 through 2004, he was the president and chief executive officer of USI's executive benefits practice. Since that time, he's been a consultant to banks and corporations for their executive benefit needs as part of the M Benefit Solutions and M Financial Group. His expertise in the review of the legal, actuarial, and financing of executive benefits and life insurance programs, as well as timeline control and presentation ability to board committees, has been obtained through the completion of hundreds of corporate engagements and board presentations. He's a registered representative with M Holding Securities and a current member of AALU. John's a member of ABA, ICBA, and various state banking associations, as well as the Financial Managers Society. So Cole and I, as you can imagine, are going to be talking with John primarily about how business owners can be using corporate-owned life insurance as a way to not only attract talent, but also how to use these policies as a cash flow management tool in order to fund other business expenses. So without further ado, here is our discussion with John Gagnon.
John, welcome to the show. Super excited to have you. On behalf of Dr. Murphy and I, we're really excited to kind of dive into your career and all the work that you've done with corporations. You come at the industry, businesses, founders, startup entrepreneurs from a very interesting perspective. First question that we ask all of our guests right out of the gate. Coming out of 2022, there was a pandemic. There was a kind of a quasi-financial crisis in some areas, environments of high inflation. You deal with a lot of balance sheets, a lot of founders, a lot of corporations. What's happening out there? What are you seeing 2023? Are we optimistic? Are we pessimistic? What do you feel?
Good question. And I think it's a little, certainly 2022 was a very strong year for a lot of companies that we dealt with. They did very well. Going into 2023, I think a lot of the forecasts are somewhat, I won't say pessimistic, but cautious. But I think underlying, I think there's a fair amount of optimism. I feel that, every month that goes by, the CFOs that we're dealing with, that they, their forecast is X, but I think that underlying that, there is some more optimism than they're showing. For us, our focus is executive retention. That's still a focus with every client that we're working with. That has not gone away. And clients are coming to us basically saying, how do we solve?
Can I extend on that, John? Because I know anecdotally, just looking like in the retail sector, you just go out and went to go get a sub the other day and the place had to close early because they didn't have any employees who showed up and things like that. You see this anecdotally, at least in that area. So is that just all over? I mean, the official unemployment rate is the lowest it's been in decades, that sort of thing. So even in terms of highly compensated executives, is that sort of scarcity that it seems like the workers are picking and choosing?
Yeah, it's definitely the case. It's interesting. We do a lot of work with banks, and even from a regulatory standpoint, regulators are coming into banks and basically saying, which has never happened before, one of our biggest concerns going forward is executive management and succession. Where are you going to get the talent from? And that's never been the case before. A regulator basically putting that kind of at the top of the list, saying, what are your plans? How are you addressing keeping and retaining talent, retaining talent? I've seen that in a lot of the companies that we're dealing with in all different types. So we were on the phone with a large waste management company yesterday, same type of thing. We've got a whole group of younger executives, and they're being picked off. What do we do to, do we do an ESOP? Do we do deferred comp? What are the different things that we could do to retain? So yes, I'm seeing it certainly at the executive level.
Wow. This is only the third episode of our podcast. And I could speak for Bob, I think, when I say this, is that we're starting to see a trend here. We're bringing people in that have a general kind of theme of experience of working with corporations, CEOs, founders, entrepreneurs, what have you. And our last guest had the same concern. We asked them the same question out of the gate. Coming out of 2022, what are we seeing as a challenge, upside, downside for 2023? And our last group said the same thing. Retainment, people. This is a problem.
Uh-huh.
And so you're seeing, John, you're seeing that as the number, just to kind of really overly simplify it potentially. You're seeing that as the number one pain point? Would you say, from a challenge perspective, that CEOs is retainment? Is it keeping? If they have good people, is it keeping them?
It's tracking and keeping them. Yes, and it's gone deeper. Years ago, I felt for a lot of the companies we worked with, it might have been a few people in the organization that the board was concerned with, or ownership was concerned with it. Our CEO, our CFO, head of sales, whatever it was, chief lender. And it was a small group. And now I feel that companies they're going deeper. Now it might not be as rich of a plan that they're going to do for the CEO, but they're going deeper into the organization and saying, how can we create various levels of retention, LTIP type programs, or something for that level. So it's still probably the top 10, 15% of all executives, but it's deeper into the organization.
John, can you talk a bit? Do you understand or have a feel for what may be the drivers of that? Because obviously this is your area and you would have your finger on the pulse more than I would. But yeah, just for my sort of arm's length observations, it does seem like this has become more common. Clearly, like we all know, back in the 50s and 60s, you went to work for GE or Kodak and you were there forever, and that's not the case anymore. But I'm wondering how much of it is just technologically, like it's easier for firms and employees to find each other like halfway across the country, but is it also like the change in the culture that everybody kind of expects that this is going to happen, so they do it, whereas maybe 20 years ago, it would have been a bit unseemly for people to be bouncing around so much?
No, I think it's generational. We're still having a lot of boomers retire, and that's playing a big role. And those are your C-suite people. You're coming in with the next group. Definitely, the access to opportunities has never been easier. You pull up LinkedIn, you do any type of search you want. You're looking. It has never been easier. And on top of that, the willingness of companies to say, sure, I don't, if you want to sit in Chicago while we're in Boston, that could work. Can you come here, every 6 weeks, or, how can we make it work, is definitely playing a big part of it. And I think that's also driven from the executive side, where they're saying, I want some type of lifestyle balance. This is what I want. This is the type of company I've always wanted to work for, but I'm not willing to go across the country to do it, but we can find a way to make it work.
John, it's so interesting. Just to take it a little bit further into kind of the problem you identified, the problem with retainment, keeping people, getting people to work, keeping people working. We identify problem around boomers retiring. There's a generational kind of rollover, happening right now. That's a lot of inventory, coming out of the workforce. So, we see that, but then we also, see COVID, and we see governments that, paid people, like kind of culturally paid people not to go to work as well. And so is this a perfect storm? And if it is, how would you describe the solution? Like from a product perspective, what are CEOs coming to you? What are they looking at in terms of a product that they can bolt on to their businesses to get people to work and to keep them working?
Yes, the overall compensation package is certainly changing. And, what's it comprised of? Traditionally it was base, bonus, and a pension plan. That was pretty, to your example, You don't work for GE for 30 years anymore and retire with a great pension. And a lot of those companies have done away with their pensions. I mean, most defined benefits are frozen today or being terminated. So what's the alternative? How do we redesign the overall compensation package for those? And I'm primarily focusing on that top 15% of the employee workforce that at least is our market. And it really comes down to, obviously, base and bonuses is always going to be an important aspect. It's got to be competitive. Work, some of the things we just were mentioning, work style, work-life balance. Do I want to work 70 hours a week is important versus, can I somehow do it and be remote? And then other types from the ownership or board's perspective, how can we, we don't mind paying, we want to pay top dollar. We're okay paying for results and top dollar, but how do we do it in a responsible manner that leads to retention? We're not always concerned that as soon as we pay our year-end bonus that, we get hey, thanks, but, I'm leaving for a better opportunity. That's not what we want to happen. So I think different types of plans are certainly coming to the forefront. I mean, deferred comp, for one, is something that's been used significantly at your largest companies, your Fortune 500. It's the ability for executives to defer on a pre-tax, tax-deferred basis, almost unlimited amounts. Very attractive. Even if you look in that marketplace, even on a pure voluntary basis. As an example, if I'm an executive and I've been in a deferred comp plan for 5-6 years, and I have an account balance of, $600,000-$700,000 of bonuses that I've deferred. If I leave, most plans are set up that's paid to me in a lump sum deposit. Well, it's my money, I'm vested in. But as a participant, I may be looking at another opportunity, but do I really want to take a tax hit on $600,000-$700,000 a lump sum? So even though it's a pure voluntary plan, that's functioned as a retention aspect. And then you add into it corporate dollars that have vesting attached to it. I've got $1 million in my deferred comp account. However, I'm only 50% vested. But if I stay another 5 years, I'll be 100% vested. And it's got to be $3 million by that time. And I don't want to walk away from that. So I think the overall theme is how do we design a comp package that makes it hard for someone to walk away. There's a pain point. And that's really what overall comp design is about right now is, we're not going to pay you top dollar, but we're not going to make it easy for you to walk away. You're going to leave something on the table. And whether that's deferred comp, whether that's an LTIP, that's really the overall philosophy.
Bob, if I could, I want to ask you a quick question about something John just said about, I'm thinking about kind of like a free market approach to the idea of, say, an employee that has 5 years of vesting, they're 50% vested, they have 5 years of vesting left, but they're miserable in their job. Say they don't want to be there. This is what we get for having an Austrian economist as a co-host. We get him to weigh in on these things. So you have the employee, they're 50% vested, they're miserable, they're going from an efficient, I think where the question, I'm kind of going really with the question, from a free market kind of perspective, in a sense, is it almost for better for the employee to, without getting into the math of it, is almost the employer to say to the employee, look, you're miserable, take here, I'm just going to vest you, get out of here. We're going to replace you with someone who wants to be here. Can an Austrian economist weigh in on any of that at all?
Well, yeah, I mean, that sort of consideration is definitely in there. I mean, the fundamental issue here is that people can't be slaves, right? And so, like the fact that you can walk away at any point. So that's what's it, as John was going through these, like that's the rationale for these, if you're just buying wheat futures or something, you don't have to worry about it because the wheat doesn't have a say in what it does. But so here, yeah, the fact that people can just walk away at any point, or like you said, Cole, even if they sign some contract saying, oh, I promise I won't, if they're miserable and they can, their work will reflect that. So everyone's got to be happy to be there and be on board. That's what's good for everybody. And so, yeah, and that's the trouble that they face. That, you bring somebody in on the front end, clearly they're learning how the company works. They're not as productive as they will be in year 2. So you don't want to just, if you're paying them a flat amount, you don't want them to just learn the ropes at the big company and then leave for some startup and, take the knowledge over there. So that's what, the trade-offs are in all this. And yeah, I think they do have to make judgment calls like that, where if they realize it's in nobody's best interest for this person, to stick around if they're just doing it to get the vesting. But again, all this stuff is tricky, because if people look ahead and know that that's the situation, well, then, that kind of affects maybe the original structure. Like the company doesn't want to find itself in that position too.
And
the stuff's tricky.
And there are rules that you cannot just vest somebody. That's an acceleration of vesting, and you basically acceleration of payment. IRS doesn't allow it. So there are issues in that regard too that you have to be concerned with.
Like I noticed too, like when I was coming out of grad school. So John, I went to NYU at the time. When I left, it was like top 15 or so economics program. And I liked teaching. Like I didn't have a problem teaching like at a liberal arts, college. Like I wasn't, it's not that I needed to go and be on the cutting edge of research and whatever with government funding or anything. And so I applied to a bunch of schools and I wasn't even getting interviews, and I was trying to figure what the heck is going on. And I realized it's because they thought this guy's not serious. Like he's not going to come and stay here. And even if we did hire him, it's just because we were his safety school. He'll stay here for, a semester or two and then leave. Yeah. So why would we bring him in? So, I mean, there's all sorts of things. Like it really is an issue of, getting somebody there and keeping them. And, and this is what you got to do. If it's voluntary, you got to come up with a way to, to keep the carrot a little bit ahead of their face so that they don't bolt.
Yeah. What I find interesting also in that regard, the remote work, we see companies that are so far apart on that philosophy. We work with companies that are like, no, we want everybody in the office. We work, we missed 3 days through all of COVID. Everybody was in. That's our philosophy. And then others, same industry, everything. And they're like, oh, no, we were out for 2 years of COVID. And, if you want to work, ours is, we try and get everybody in here once every 6 weeks for a company meeting. And we basically tell them, don't schedule any meetings that day. We just want you here and kind of socializing with your other associates. It's really amazing.
It really seems to be all over the place, doesn't it? I mean, it's almost like, how dare you you can't ask me to come to the office. And in other cases, it seems like people just want to get out of the house and get back to work. I'm sure it's measured somewhere. I'm sure we could like Google like what the general kind of consensus is, and like how this is really trending. I'm sure there's some kind of HR database of this kind of information. John, your company is called COLI.com. Your website is COLI. Did I get COLI? COLI.com. So bank-owned life insurance, corporate-owned life insurance.com. There's a theme of life insurance. Your website has become, I think, for me and I know some other people, a bit of a funnel of sorts. I know that people are interested in life insurance, say, for whatever strategy as a product, from an asset perspective, from a leverage perspective, from an HR perspective, almost even in a risk management perspective, from an HR perspective, as we're talking right now. When you're talking to your clients, can they look at a life insurance product? So say as an example, we have this person that comes in, they're 50% vested, they hate their job, they don't want to be there anymore, but the employer is running either a BOLI or a COLI strategy in their company. So they have a key interest, they have life insurance on that person, that key person, they have insurable interests, and that person leaves. Now, do they keep the life insurance? Does that company able to hang on to that life insurance policy after the employee leaves? And if so, does that de-risk the volatility of HR and that person leaving for the company? And is that a conversation, that you're having kind of on a regular basis with CEOs and employers?
Most definitely. They're keeping that, 9 times out of 10, they're keeping those policies in place. And that's discussed before it's implemented. They know that it's going to happen. Not everybody's going to stay at the company. You're going to have turnover. People are going to retire. COLI and BOLI strategies, it's generally to hold these policies for a long time. The policy on that one person who left the company, retired from the company, is not tied to their benefit. When we look at utilizing BOLI or COLI, it's really on an aggregate funding basis. How much cash within these policies does the company need for various circumstances that may arise. Is it to fund deferred comp? Is it to fund buyouts? Is it for other liquidity needs? What are they using that liquidity for? So most definitely the policies are staying in place.
Guys, if I could just take a moment, because a lot of our listeners are already, they're going to be familiar with the stuff Cole and I have been doing for years, and they'll know this. But just in case we're catching somebody who's listening because they're a business owner and this is brand new. So the premise is that you are, as an employer, are taking out a life insurance policy on key employees because you have an insurable interest. If they got hit by a bus, that would negatively impact you, just like you have fire insurance if the building burns down. If that employee doesn't show up to work tomorrow, that affects us. And so I want to have life insurance in place. And then in general, if you have an insurable interest with somebody and then the situation changes, you still keep the policy. Like even if, spouses get divorced, the life insurance policies they took out 10 years ago are still valid. But then you're saying the particular life insurance policies, they're not term policies. They accumulate cash. And so the company, while the policies are in force, can access the cash that's tied to them. And so it's not simply there in case the guy dies, but it's also got cash there.
Yeah, from a regulatory standpoint, your 101J, your right to insure employees, is that you're utilizing that either the cash growth in the policies that you're booking as income, or the death benefits that ultimately are received as a way of offsetting employee benefit expenses. Okay, that's really what your insurable right is. If you didn't have any insurable interest, you can't put insurance on an employee. It has to be based on something. So there's generally some type of plan behind it, whether it's to offset employee benefit expenses or your medical expenses or your group life or a deferred comp plan or a SERP or a long-term incentive plan. Those are all legitimate reasons of why a company could hold life insurance policies on individual employees.
Don, we all know that running a business is hard, that we see the success or failure rate of startups all the time. It's a very small percentage of startups to actually move out of the startup phase and into operational and become successful. We identified at the top of this conversation that one of the most risky components of running a business are people. Are CEOs and founders and corporations, are they picking up on the advantages of what we're talking about here? Is it growing in popularity? Are you getting busier? Is your phone ringing? Or are people reaching out to you and saying, hey, this is something that can, really benefit, my business? And are we trending in the right direction with this as a risk management solution at a high level, would you say?
Yes, definitely. And part of that is access to information. The analysis of these policies is granular. You can really get into it. The quality of available products on the market today is better than it's ever been. And, you have a lot of historical data. Certainly the tax advantages of non-taxable cash accumulation, tax-free loans, tax-free debt benefits play a big part. So yes. And I also think that just the types of plans, as I mentioned earlier, certain types of plans have always been very popular at larger corporations, deferred comp, SERPs, Fortune 500. And a lot of that was driven because, in those companies, you had 50, 100 people that were making a lot of money. Today, there's an awful lot of large private companies. We have executives that are making a lot of money. And so you need these solutions. You need these funding options. So it continues to be driven down, and the products are just better than they've ever been.
Can I ask John a follow-up on that? I'm curious your take. Cole and I are quite familiar with this, but there's this weird dichotomy, certainly in the United States, I believe in Canada as well, where everybody kind of knows, or not everybody, but a lot of the insiders know that, oh yeah, banks and other corporations use these types of policies all the time. It's a no-brainer. And yet the financial gurus, people like Dave Ramsey, Susie Orman, will tell people, oh yeah, getting a cash value life insurance policy is a terrible place to put your money. That's just insane. Why would you do that? You've been sold a bill of goods by some snake oil salesman. So how can those two go together? Like, I don't understand the people saying that. Like, how do they reconcile? Like, do they? Anyway, I'll stop, and I don't want to give you what I think the answer is, but you understand my concern, right? Like, how could it be that it's a stupid thing to do, and yet, oh yeah, these big companies do it all the time?
Yeah. Well, the whole delivery system of insurance has changed significantly over the last 20 years too. You don't have agency systems, general agency, they're not what they used to be. And back in the day, you worked for one carrier and that all you did is distribute their product and it was supposed to solve every need. And that's generally not how it happens today. And not every carrier has a great product for every situation. I think it's just the opposite. Most carriers have a handful of products that fit that's their specialty. And so you have to be able to have access to that wide range of products to solve those issues. But to blanketly say that, it's just not a good solution just doesn't make any sense in my mind. If you can do the math, it works. The large company CFOs that are very intelligent, believe me, they do the math and they think, why are we doing this? Where's the advantage? And it makes sense.
I'm going to take a stab at your question, Bob, as well. And I think it's widely understood that, to your point, John, that Dave Ramsey and Susie Orman don't think that, say, retail users or the average person can do math. And that's essentially what they're saying, because their brand has been built around telling them that they're stupid, essentially, and they shouldn't try and do math. And I'm sorry, but I'm just kind of going to say that because that's what I believe. But if it comes down to it, and is it fair to say that there's an opportunity for education? Is there an opportunity here, would you say, for, to Bob's point, if banks are doing it and corporations are doing it, then if some version of it, now we know that the average person can't do BOLI, right? A family can't do BOLI, obviously. Wow. A family can't do COLI, but the average person, say a small business, let's put it that way, a small business can do their own version of it, a relative, the cash that it takes, the premiums that it takes to fund these things can work on a sliding scale to some degree, right? The mechanics and the utility of the product is really about ownership, insurable interest, a beneficiary, and a payee. I mean, there's kind of four actors in the game here that are consistent, whether if it's COLI, BOLI, or a small business, for example. So I guess my question is around education. If the average person, the average small business owner were educated, if life insurance agents were educated, would the Susie Ormans and the Dave Ramseys of the world be able to get away with saying that and ignoring the fact that the richest companies in the world are doing this? I guess my question is, do we need to educate life insurance agents more?
I don't know if it's that we need to educate life insurance agents more, or we need a probably a better delivery system for the average consumer. Because, you look at the certain markets, whether it's high net worth or the COLI market or the BOLI market, there's lots of strong technical people in the business that work those markets. The average consumer that's, saying, hey, how should I buy some life insurance? There's not a lot of folks in my business that are, sitting across the kitchen table explaining to these folks why they should do that. And the products they really are just as good. You can go from one extreme, which is, private placement. Private placement is, you have to be not only an accredited, you have to be an accredited investor, $5 million of investable assets, things like that. And that type of product really isn't that much better than kind of what I'd call a street product. If it's designed right, and that's part of it. A lot of the products today is flexibility, and part of that flexibility is how much compensation is dialed in. But if it's designed correctly, there's not a whole lot of difference in performance. The big difference of private placement is you have access to alternative investments and different types of investment managers that you might not have in that kind of shelf product, if you will. But at the end of the day, they're pretty similar. So I still feel that there's a weakness in the delivery system for your average consumer.
Do you, John, notice when you're meeting with business owners, I guess if they're coming to you, they already understand the benefits of BOLI or COLI and just want you to, kind of get particulars with them. But I'm wondering, is there a sense in which you think that, there's plenty of businesses out there that our solutions would be perfect for them, but they have this buy, or it doesn't even occur to them to use life insurance?
Yeah, it's still, I don't think anybody in our business is, their phone's just ringing off the hook and they can't keep up with the, with the demand. I mean, it's still an industry where we're out talking to people all the time. And a lot of it is not, frankly, about the life insurance product per se. It's about the problem they're trying to solve, retaining people or solving for estate taxes or death benefit needs of a couple. All of that, what's the problem? And then let's find the solution and what's the best, product fit that's going to work for your situation, your budget, et cetera.
I'm a resident of Canada, the United States, and the Bahamas. In the Bahamas, I have a few friends that own private placement companies. On the other side of it, and I'm seeing how their business is growing. So it's, to your point, you said earlier, you have to be accredited. You'd be considered to be a high net worth person that can, generally speaking, take advantage. I'm not going to get into all the mechanics of what one of these private placement products really looks like. And there's a lot of companies, out of the Bahamas and, places like Cayman and et cetera. All over the world, there's different jurisdictions for these home offices for these private placement companies. On the other side of it, we're seeing another category in, say, the life insurance space, which is final expense kind of growing. So you're like these ultra high premiums and the really, really kind of low premiums. So these two categories seem to be growing kind of simultaneously, which is really, so one extreme kind of to the next. And I guess I'm just kind of like personally kind of really curious as to, just to ask just a very straightforward, ask the question in a really straightforward way. I mean, why are more people not doing it? Does life insurance, so I work in technology and I work in life insurance. So it doesn't matter if in Canada, the Bahamas, or the United States, if I walk into a room and generally speaking, if I say I'm in if I'm in Bahamas and I say I'm in life insurance, people are usually okay with it. But if I'm in Canada or the United States, especially Canada, and if I say I'm in life insurance, I clear the room. I mean, people run away. If I say I'm in technology or blockchain or something, which I do a lot of, then, I mean, people are like, oh, okay, let's talk about that. If I'm in the Bahamas and I say blockchain, people clear the room because of what happened here recently. Yeah. But and I don't even call it crypto anymore. I just call it blockchain in the Bahamas because, there's this thing called FTX that happened here a little while ago. But so what is the issue? Like, why do I clear a room when I'm in Canada, especially, or let's speak the United States, and I say I'm in life insurance? Why do I clear the room when this is something that really business owners and banks are doing and people, generally speaking, need?
We see a lot of interest, frankly. I frankly don't feel that way. I feel like it's definitely a top of mind. I think in the last 5+ years, there's been a lot of very positive aspects of the insurance industry, whether it's articles in the journal, et cetera, that have really taken it up on another level. If in the business, certainly in the business community, in the high net worth area, in professional services, I'm seeing a tremendous amount of interest in these types of products and the problems that they can solve.
Yeah, I'm wondering if it's kind of like you guys are seeing different sides of the same coin, maybe that more people are understanding it and they're the ones that are going to be going to John. So that's from John's perspective. If people think it's a terrible idea, they're not going to call him up, right? So whereas Cole, you're actively, you're going into uncharted territory and you're, approaching people who don't know who you are. And so that could be part of the reason that you're having these different experiences. I'm wondering, John, just, again, I'm having in mind the people listening who are interested in starting a business and they didn't know any of this stuff. Can you just elaborate a little bit more? Because you just mentioned even there, like how it's solving a problem. So I can still see someone saying, I still don't get it. We talked about retaining employees. I get how if I took out a life insurance policy, as the business does, it's good for the business, but how does that help me retain an employee? Like they're just not connecting the dots. Can you just speak a little bit about that?
Sure. It's if you think of a 401k as an example, the plan is that the company's putting in a match or a contribution. That's the plan. Then it's setting aside the dollars. That's kind of the solution. And the same thing on the executive benefit side. You're creating what's the plan? What are we providing to you? As an example, you might have a plan that says, we have a 401k, we have a pension, but you're capped out on a lot of that. You're only going to get so much from those because of the governmental caps on what can be contributed. So we're going to write up a document for you that says that when you retire, you'll retire at 60% of your final average compensation. And we'll figure it all out. We'll figure out how much is coming from the 401k, how much is coming from the pension, Social Security, and we'll make up the difference. And we'll fund that using COLI. That's how we'll make it efficient. Okay, we'll fund it, but that's the plan. So we can hand you an agreement that says this is what you're going to receive. There'll be vesting attached to it to make, put some retention aspects to it. But that's so there's always some type of plan like that attached to why you're utilizing COLI. On the other hand, there's plenty of companies that we work with that they just want it as a funding source. Construction, development. They need bonds, they need cash. Life insurance cash values are a perfect fit for that. So they buy lots of just cash value policies to have on the balance sheet for bonding purposes, for funding projects that they borrow from the policies to fund these projects. It's just different needs of why it could be. As a young company, if I was starting to advise, obviously cash flow is always an issue with the young company. I mean, you're trying to, whether it create sales or sell whatever you're selling or build whatever you're building, cash is king. However, it's just like, from a personal standpoint, if you can set a little bit aside along the way, compounding effect, and the same thing with permanent insurance, compounding effect, all of a sudden you're 5-10 years into the plan, and you've got some significant money on the balance sheet within these policies that you can then use for the next phase of what you may be trying to accomplish is powerful.
Wow, there's some real nuggets in there, right? That was really powerful, everything that you just said. So if I'm a business owner and I'm hearing that, the one thing, and you answered it already, but I want to ask it again, just because I think it's that powerful, is that why would I use life insurance? So you just said, John, that I could use life insurance to finance my business. How would I actually do that? What is the lending mechanism? Who wants to lend me the money for these things? And why would I use, say, one of these policies versus other, say, financing models?
So it's certainly not going to happen overnight. You're going to build up cash in these policies, but at some point in time, it is a source of capital for a company that's easy to tap into. One of the tax benefits of life insurance is that you can, when you withdraw capital, which is called cash surrender value out of the policy, you're not taxed on your basis. So if you've put $1 million in and you've got $800,000 of cash and you want to take it all out, it's non-taxable. You paid it with after-tax dollars, and that's non-taxable. If you have $1.6 million of cash and you take out $1 million, again, it's non-taxable. If you go over that, what companies will then do is borrow out of the policy. And when you borrow out of the policy, it's also not taxable. And when you're borrowing, you're essentially paying it back to yourself. It's going back into the policy, the rate, and how some of these products are designed is really to be advantageous to take loans out of the policies. So there's different techniques of how you can access that cash. There's going to be potentially more attractive than just going and getting that corporate loan for your need.
Can I ask too, John, to make sure the listeners aren't getting confused? A few minutes ago, you were showing the different possible uses, and you said, "Yep, certainly. Like if you're going to be funding compensation, retirement packages, and whatnot, you could use these as a mechanism." Or even, I think you said, construction companies or whatever, that you want to just have a source of cash 3 years from now to be able to start building something. You could start funding these. So those are different cases. If the company is acquiring these to be able to finance operations, and that's the point, that piece right there isn't necessarily useful for employee retention. You're just saying these things are very useful and you could use them for employee retention if it's funding, these other incentive options and such.
Right. It's just another form of capital. And, our emphasis is certainly cash. For most corporations, they're looking at this. How is this advantageous to us from a cash standpoint? Where, we've got $1 million of capital and we're going to put some of this into COLI. That's cash. How is that cash going to grow? Another big point, though, is there are death benefits, and deaths do occur. I mean, we do reports to companies all the time showing, not everybody lives to life expectancy, and death benefits do occur. And so that key person protection is a big deal. And it can be, frankly, profitable to a company, the death benefits coming in. It also can be very beneficial to employees that these are on, where the company's paying out death benefits on a premature death benefit on death. So that's another whole aspect to it that adds to the overall return that you can't get by just saying, okay, we're going to either take a loan or we're going to take this money and put it in a bank. It's another aspect that's unique to life insurance.
If you're watching this and you heard John just say a comment that just lit me up, I'm not going to go on about it, but it is so powerful. You go back about 45 seconds and he said, frankly. And if you listen to the thing he said after he said, frankly, so go back if you're watching this and listen to what he said after he said, frankly. That is very, very powerful. I'm just going to leave it at that. We'll see if anyone actually does it. We'll experiment. Leave a comment if you actually went back. You can quote what John said after he said, frankly.
I might have to go back, Cole, to remember it.
It was good. It had something to do with profitability, the P word that, a lot of what entrepreneurs get up every day to go and do is to be profitable.
Right.
So it was pretty good soundbite. Appreciate that.
Can I ask, John, but just for you to clarify too, because I know some people are listening and wondering, are you saying, is it sometimes common to share some of the death benefit with the employee? Like, is that part of, and can you just speak to that a little bit? Like, is that common or,
yes.
Or just how does that work?
Yes. I mean, if you're asking an employee to be an insured under one of these programs, you're generally giving them something. Whether it's part of it, whether they're participating in the deferred comp plan or they have some type of supplemental executive retirement plan or something, but it's also common that if for a company that just says, we want to build up some COLI, that if you're asking them to be insured, there's a sharing of that death benefit. And it might be as simple as, everybody who's an insured gets a $100,000 death benefit if they were to pass. It might be one-time salary, whatever the amount is. But there should be an incentive for why they're signing on the dotted line to say, yes, I'll be insured.
Right.
And so that's even just yet another example of how it helps with employee retention. That's just another benefit. You come work for us. In addition to everything else, something were to happen to you, you've got extra $100,000, your widow gets, or widower, if you're hiring a female.
Right.
So yeah.
Yeah. Or your children. I mean, just again, to your point about retention, I mean, what a beautiful thing that is that, that happens, and then your family, your beneficiary gets a bonus. I mean, that's really powerful stuff.
It's been interesting. Sorry, Cole. It's been interesting just since COVID. We've always done that, but just the feedback we've gotten since COVID, where it's actually more appreciated now than probably ever before. COVID's kind of brought that on and I think made a lot of people rethink their insurance needs, and when you're giving out essentially, free life insurance, we've had a lot of companies come back to us and say, HR folks, and say, hey, it's really went over well. I mean, they really were thankful. So
I love that you just said free life insurance. I mean, essentially, you have to be careful with the regulators and compliance, and you kind of use, the term free with, so there's an asterisk on all of that. But mathematically, getting back to math, when you look at it, it's kind of free life insurance, right? I'm going to say kind of free life insurance because I'm sure someone would have an issue with saying that from a regulatory perspective, because I guess it's technically not. I mean, someone's paying for it, but there's a great value in all of it that conjures the word free. So we'll digress and philosophize about that maybe another time, but something I think about, quite a bit.
Yeah, no, good point.
Two products, or I guess concepts or kind of strategies that we're thinking about here. We're talking about our BOLI, so bank-owned life insurance seems to be pretty targeted at banks. And then COLI, corporate-owned life insurance, obviously targeted at corporations. I mean, the definition of a bank is pretty straightforward. There's a charter, and there's a business that kind of surrounds the idea. Corporations is a little more broad. How would you describe a corporation that is a good candidate for this? I mean, is there a certain number of employees that they have? Is there a certain structure they have? So for a listener kind of looking at watching this podcast, and then you're going to say, hey, that's really interesting. I wonder if my business qualifies for COLI. We know if they qualify for BOLI or not, but what criteria would they have to qualify for COLI?
Tax status of the corporation is important, whether they're a pass-through S Corp or a regular Corp C Corp, preferable as a C Corp, but not, most companies are not. Most companies today are some type of S Corp. Now, it's most beneficial for an S Corp if they're trying to create benefit programs for non-equity owners. We see that often. Get a large S Corp and they don't want to give up equity, but they have key executives that they want to do something for. COLI's perfect fit. The size of the organization, it matters to some degree as far as access to certain products, how you're implementing it. You can implement things. We've many of us have applied for life insurance, and you go through a medical and all that process, and that's still common. But a lot of companies can also, if you have enough employees, generally 10 or more, as a group, you can have COLI implemented without any medical underwriting. It's referred to as guaranteed issue, and that's very powerful for a corporation to be able to implement it that way. So, the size of the company certainly can matter, but those are really kind of the variables. Most importantly is, what's your need? What type of problems are you trying to solve? Is it employee benefit or retention? Lots of good uses for COLI. Is it, to build up capital? Again, the only thing I would preface there is that it's not going, if you're looking for something just to build up capital, it's going to take a little bit of time before you're really going to, you're not going to implement the COLI plan and then access to cash next year. At least I wouldn't recommend it. It's going to take some time. But it's for a buy-sell funding that you're going to use that cash some point down the road to buy out one of the existing partners. Great strategy, but again, it takes a little bit of time. Generally, 5 to 7 years is optimal or more.
The distinction between BOLI and COLI, is it just because historically banks were using this a lot and so it became its own term, or is there like a qualitative difference between bank-owned life insurance versus some other corporation that's not a bank?
Yeah, there's definitely a qualitative difference. Banks hold BOLI generally until death. They do not access the cash. They generally do not access the cash ever. And it's done with a single premium modified endowment contract.
Mm-hmm.
So they'll use what's called a MEC policy, a single premium. They don't have any problem saying, yeah, we need, we'll take $10 million and transfer it to XYZ insurance company, and it's on our balance sheet now as BOLI. And we don't need that cash until these insureds die. It's just going to sit there, and it's generally a fixed income, crediting, in today's market, somewhere around 4%, non-taxable to a bank. That's tax effective somewhere around 6%. For fixed income, when they're comparing it to Fed funds and treasuries and things like the other alternative investments, it's attractive. So that's what a bank will do. A corporation generally is not going to come up and, write a check for a lump sum of $10 million. They'll put it in over time. So annual payments into these types of products. And the products will either be, whole life, universal life, variable life that has mutual funds in it, different types of products. But that's the primary difference between the two.
Intuitively, is it just because the one type of institution that doesn't need to be able to borrow money from people is the bank? Because no, people come to us to borrow money. We don't need to.
Correct.
Okay.
Correct. Banks can raise capital.
Right. So the modified endowment contract, say a 10 million single premium, 10 million contract, modified endowment contract would suggest that if the bank were to access the cash, then it would be taxable, first off. And so that's part of the reason. And then to Bob's point, because of the deposit banking or the fractional reserve system, essentially because it's on their balance sheet, they can lend against that. Is that accurate? Is that a true statement that they?
It's part of their capital. The only thing they'd be taxed on any gains in that contract, plus a 10% penalty on gains, Irish penalty on those gains.
Right.
So that's, the modified endowment rules, but it's still it just becomes part of their capital.
Right. And then could a corporation also, if it worked within their strategy for whatever reason, could a corporation also participate in a modified endowment contract, like a single premium MEC type policy if they wanted to?
Yes.
Yeah.
Maybe we should just go ahead for the benefit of the list. So the deal is there's under U.S. law that the way you fund these things, if you put too much money in up front, it becomes a modified endowment contract and it loses some of the tax advantages in terms of policy loans and accessing cash. But since the banks typically are just going to let it sit there as an asset, it grows and then they get the death benefit, that's still tax-free. So the tax-free death benefit is not negatively impacted by it being a modified endowment contract. But for other corporations that want to possibly use it as a cash flow management tool, other things equal, you wouldn't want to lose that. So you'd fund it over time. So it wouldn't be a MEC.
Correct.
I feel as though this conversation is just starting in some ways, but I think for purposes of you'd be able to apply a lot of what it is that we're talking about. We've given our base a lot of Googleable bullet points that could probably dive into. Not to mention, when you Google a lot of this stuff, you'll probably find John's website because he's done a great job with his SEO.
Yeah, let me mention that. Some of your material, before I knew who you were, like just I was doing research on this kind of stuff, and yes, something came from your website. I was like, oh yeah, these guys are good. Like this is good stuff.
Thank you.
Yeah, no, absolutely. I mean, John's done a very prolific and a remarkable job, kind of from a marketing perspective as well, which is a great example to a business. I mean, business people are coming to you; they want to marketing is a core component to a successful business, and you've done a great job with that, John. Not only are you an expert, but you've done a great job marketing as well.
Appreciate that.
So on behalf of Dr. Murphy, if you don't have any other questions, John, we'd just like to thank you. That was a super exciting conversation, and we look forward to more people diving into this, more businesses diving into this this great strategy.
Great. Well, thank you both very much. It was enjoyable, and happy to answer any questions in the future.
This concludes another episode of the Founders Forum. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the hosts and for previous episodes, visit foundersforum.io. Thanks for listening.